Welcome, guys. Welcome to another Mind Over Markets. Super excited to be with you, on this Sunday. I always love doing these because it's a great way to get your mind, ready for the week. A big part of trading is your psychology. A big part is your mindset. And it's, a lot of people take this for granted because this is really what makes you, right? This is really what decides if you're going to be successful or not in this market. And so I'm so elated to be teaching these things because all these things I'm teaching is off of experience. I want to cut that learning curve for you. I want to be that one that helps you to, work out your mind and conquer yourself, because it's really a battle. It's you versus you. In this market of abundance and opportunity, you're the only one that's going to be stopping you from getting to where you want to be. And it's your mindset. All right. We're constantly, on a war, right, on a battleground, and we have to make sure that we're prepared. We got to prepare for war. All right. So today I'm super excited, to be here, and we're going to be going over something that's very important. All right. This is the next, rendition of the series that we're doing with Mind Over Markets. And today we're going to be talking about adapting your mental framework to the market maker model. All right. Now, some of you might not know what a market maker model is. All right, but it is a fractal in price, right? It's really how the market makers do their booking, okay? And how, they onboard their positions and offset them to willing liquidity, all right? I'm not going to get too much into, the market maker model, but I will get more so into the emotions and the psychology and how, right, to adapt your mental framework when you're within this fractal. So the first question I want everyone to just meditate on, right, is what makes you you. You have to know yourself in the market, all right? You got to know yourself. This is the first step to adapting your mental framework to the market maker model. So just sit back, right now, and just ask yourself, what makes me me? Who am I, right? Am I the type of person that likes to, be one of the first ones to do things, right? Am I a pioneer? Am I more risky, right? You might want to catch smart money reversal if that's you, right? If you want to get in early, you might want to catch that smart money reversal, which is a stage in the market maker model. Or, you're probably a person that likes to engage in simple and easy tasks, that have a good risk with little to no effort. Well, the last, accumulation stage might be for you, the silver bullet within the market maker model. So you have to ask yourself these questions, right? Are you a type of person that likes to go for the low-hanging fruit, the easiest objective, then the lowest buy in the market maker model to the first, array, and a premium might be for you within the market maker buying model. So these are things that you have to ask yourself, right? And these are the main questions that I had to ask myself. What's my personality, right? What do I like doing more? Personally, for me, I love to catch the lowest buy or lower sell, to the first array within a premium or discount. This is the, that piece of the move is really what ICT wanted to teach. It was what he taught in the 2022 mentorship, right? That low-hanging fruit objective. And I love taking that because it's easy, right? Or you may be the type of person that loves to capitalize, on great risk reward opportunities. Well, then catching the whole move, right, from the lowest buy all the way to the original consolidation might be for you. So you have to ask yourself these things because this is going to help you determine where you're going to engage, right? And when you determine the type of person you are, it's also going to determine the times that you're on the chart, because the market maker model, right, is a fractal within price. It occurs on the 1 minute, the 5 minute, the hourly, the daily, the weekly, right? And so when we break this down within a weekly range, there's certain times of the week you're going to want to be engaging in. So all this starts from these core questions that you have to ask yourself. Now, this is just a chart, right? And it's simply a market maker sell model right here. But within it, right, more importantly, is actually the different stages and, just examples of the type of emotions and the type of patterns that might arise within your mental framework given each stage. So just like we look for and journal certain patterns in the market, it's the same way you need to start journaling the patterns that happen within your mental environment, which arise from certain triggers within the market matrix model stages, right? So, for example, the first stage we have right here is basically the original consolidation, right? We have this original consolidation right here. And, you know, personally for me, I love to wait until it's confirmed, right? We confirm it with a market structure break and we actually break out of this range. Why? Because here, usually for me, there's a great deal of uncertainty, right? And I know myself. And when I choose to engage within, you know, the original the original consolidation, right? I basically start trading off of boredom. And I'll try to enter trades when no trades are really there, right? I don't have a clear depiction of where price is going. It's kind of 50-50. And in those market conditions, that's when you can start gambling, right? That's when that gambler that I talked about before comes out, because it's 50-50 conditions. It's range bound, right? So I like to wait for that breakout of the range and expansion to actually just give me more confirmation and, you know, more confidence. Now, the next stage, you know, that I have here is actually, right, the first accumulation stage that we have. And within here, right, within this fair value gap, you can see that I've marked, you know, confidence or greed. So for some people, I'm not saying this applies to everybody, but for some people, when you get to this stage, right, of the market maker model, you might get very, very confident. And this might, you know, lead to you upping your risk, you know, using more size than your account can handle, because you get greedy, because you know where price is going to go. Even though we have a great deal of certainty where the market's likely to go, right? You can never be too certain. So you always have to use proper risk management. All right. And this is what really helps people go from not being consistent to being consistent, is really their risk management. So you got to understand that when you're in this stage in the fair value gap, right, price might not play out how you anticipated. Okay. A lot of times I have a narrative, right, that price is going to go to the previous daily high, or it's going to go to, you know, the completion, right, over here. But basically, I might not be able to trade. Given this day with these wicks, this was CPI. And they make it very hard for you to actually participate, even if you know where price is likely to go. So this can actually mess up your mental a lot. And I definitely have examples, you know, different times where I've chose to engage within these conditions, you know, CPI, and I had a clear bias or narrative where price is likely to go within the market maker model, but I lost a lot of money within this chop, within these wicks, right? That's where I lost a lot of money. Why? Because I placed the stop loss right in the wrong place. I got stopped out because of the wicks. I got over emotional because I lost too much and just revenge traded, and prices ended up going where I anticipated in the first place, but I wasn't able to participate because I already lost a good percentage of my account. Drop a 2 in the chat if that's ever happened to you. Right? That happens to me a lot. That happened to me a lot before. And we can only learn from our experiences. Right? So, you know, the next stage, right, we have another accumulation stage, right, before we actually distribute above the highs, which sets up the sell model. Okay. But basically within this, it's important to understand the triggers that arise, right? The triggers that arise in these different stages. So we have overconfidence and over leveraging here. You might want to over leverage. And then when you get to, right, the previous daily high, the completion of the buy side of the curve, right, you don't really have a good read on where price is likely to go. So that can cause, again, boredom and uncertainty, right? That can cause you to, you know, try to trace trades and buy above highs, which we don't do, right? And you end up getting caught in all, you know, the smart money reversal and taking losses, unnecessary losses. So patience is key within this, right? We have another, you know, a stage right here, smart money reversal, lower sell right here, where the same type of triggers might try to come. So knowing what triggers for you is likely to happen within each stage of the market maker model is very, very important, right? When we have that last, you know, silver bullet stage right here, right? Last stage of distribution. And that can actually lead to FOMO, or you chasing price, right? You trying to chase it too low and you're ready, you know, in a deep discount, you're in a discount of the range. And so you get chopped up within all of this consolidation and lose money. So you got to understand where within this whole fractal of price are you going to be able to engage without expending too much of your mental capital, all right? And without taking too much unnecessary loss. So this is a key quote from Brett Steenbarger, right? He's actually a psychologist and he helps trading, right? People trading in the Wall Street prop firm called S&B Capital. And he basically says the focus is not eliminating under trading or over trading, but staying in the zone of optimal decision making. So this is important because many of people focus so much on trying to eliminate the emotions when really they should be focusing on keeping themselves out of the environment which negative patterns are triggered in and staying in an environment of optimal decision making. Now, this is true trading wisdom, right? Because instead of trying to eliminate the emotions that arise from certain triggers, why not just avoid that certain environment that will lead to those things being triggered in the first place, right? This is very important. So what we have to do is we have to set up protocols. All right, we have to set up certain protocols in trading that actually help keep us in the zone, right? So I'm gonna give you guys, you see a few examples on the screen of things that I do that help, but you gotta understand, you gotta know your own triggers, you gotta know what keeps you in the zone, right? So for me, I've identified that, certain days I have to limit myself to be on the chart if I'm within a market maker model, right? Within a given narrative. Right, certain time of day, I have to limit myself to be on the charts because I realize for myself, over trading could happen if I'm just sitting on the charts and I try to go search for trades instead of letting the trades come from me, right? So you have to limit yourself to certain times of the day to even just look at the charts. Next thing that I use is trading view alerts to alert when, price is getting to a specific level so that I can actually go and hunt for my trade opportunity, right? And then the last thing is eliminating all sources of distraction. I realize that a lot of times too, I'm in different trading groups or even Telegram and Discord. There's a lot of other people who have different biases and things that can actually, hinder your growth as a trader. Yes, we're in a group in the Discord, right? But trading in general is a solo sport, right? It's solely based on you and your performance. So why would I depend on someone else's, analysis every single day? Because that's just all that's going to do is just hinder my growth. I want to focus on my analysis and my narrative and what I see in the chart, because ultimately I'm the one making myself money, right? So we have to understand that, the first thing in the market we want to be looking for is the right time, right? It's time, then price. So a lot of your, problems that you face, you might not even realize it, but a lot of the problems that you face right now, right, the origin, of the triggers is simply from being on the chart for too long. That is very important because when you're on the chart for too long, you start getting those thoughts and those illogical thoughts that pop up in your head based off the price action that you're seeing, right? That might actually trigger you or cause you to enter a trade when there's not really, your setup there. So we want to do these things to keep us in a state, right, of flow and keep us in the zone, right? And, we got to understand that we must remain in a state where we make ourselves available to opportunity within the market. So we always have to maintain a state of flow, all right? And I talked about a little before, on the emotional volatility scale, we got to maintain that equilibrium. And you maintain your equilibrium when you are in the state of flow. So within a market maker model, right, we have to maintain that equilibrium, maintain that flow. And for a lot of people, that's putting themselves in the right market environments, right, and within the right time, right? So we should never be forcing, or imposing our will in the market. The best trades always jump out at you. And when they manifest, it's actually like they're screaming, "Take me," right? It's like, they're just popping out so clear. And those are the trades that you want to be taking. So it's up to us to be present at the right times within the market, right? And you got to give yourself a specific amount of time to look for setups within intraday intervals. So for example, in the New York session, you only check for potential trade setups within every 30 minutes or something like that, because your setup forms that often, or you might get more data, right, within the market within that time. You have to understand, that when you're on the charts for longer, you're going to start to search for trades and tend to deviate from your trade plan rather than wait for your criteria to be met, right? So for a lot of people, patience is a big thing, especially for new traders, right? If you're a new trader and you just started trading, you understand that patience is going to allow you to be able to harvest the profits that you want, right? You know, there's a saying, the market is just a transfer of wealth from the impatient to the patient. And it's true. You have to be patient and wait for that setup to happen, right? For, you know, the high probability conditions to happen, and not just execute in low probability conditions. So many times I found myself, and I went through my history, I went through all the trades that, you know, were not in my trading plan. I realized that they formed when I was trading in low probability conditions, right? They formed when I, you know, entered and I knew I shouldn't have entered. I got stopped out, and in my mind, I knew I shouldn't have entered, so I was mad that I even entered, and I tried to make back what I lost since I shouldn't have even entered, but then I ended up losing more money in the end, right? And so this is a recurring pattern that a lot of traders face, and to fix it, you simply just have to be disciplined, right? It's literally the pain of discipline or the pain of regret. You got to be disciplined and only engaging the market when the market conditions are perfect for what you look for, right? So this is just showing you the different, you know, ranges within the market maker model, right? So there's certain areas of opportunity where you can take trades and expect them to be high probability. So this is broken down, you know, we have the 25% of the range, the 50%, which is, you know, fair value, the 75%, which is an extreme of the range, and then, you know, the 1, which is that previous daily high, or, you know, a key liquidity pool right there. So basically within this, right, if I'm on the buy side of the curve, the 25% to 50% of the range should offer, you know, the best discount entries. Those are where they usually tend to form within that, right? And if I'm on the sell side of the curve, you know, in between the 1 to the 0.75% will basically offer the best entries. Why? Because that is an extreme premium of the range. So if I'm selling, I want to be selling in a deep premium, right? Or in a premium of the range. And that premium is anything that's above 50%, right? Which is, you know, equilibrium of the range. So if I'm selling, I want to be selling an extreme premium. You know, if I'm buying, the best buys happen an extreme discount. So knowing this is so important, because you're not going to chase trades that are not within these zones, right, of price, you know, within a market maker model. You'll look for your trade setup to set up there, and that's where you'll look to take the trade, and that's it. You got to demand the best out of price action, right? This is how you get consistency. This is how you actually, you know, get success in the market, right? Demand more of yourself. If you're not consistent yet with trading, you have to demand, right, with all your willpower, and listen to yourself, right? When you say you're going to do something, if you say you're going to go into the market with intention to only trade this setup, only trade this time, then do it. It comes down to your willpower, right? And how you actually strengthen your willpower is, you know, within those times where it's hard, when you have to make a split decision of whether to trade and take that low probability setup or not, and just wait and follow your trade plan. That's when you have to follow and do the right thing, because that's how willpower is built. All right. It's not always, you know, discipline like we hear, but more so breaking that down with the discipline, it's your willpower, because we only have a certain amount of willpower each day and decisions that we can make before it's exhausted. All right. So placing yourself in front of the charts within the specific areas, you know, will allow you to be present when high probability moves are going to happen, and we still have narrative of where price is likely to go. So I know you see the red, you know, zones in price, right? This simply is where you demand more price action and you don't chase price. Why? Because these are extremes. I'm not going to want to buy, you know, within a deep extreme or deep premium, right? Because we don't buy them, we buy in a discount. I'm not going to sell once we get, you know, here, because this is where the completion happens of the market maker model, right? It doesn't always have to hit the low. Coming back to the opening price in the Roja class consolidation can be, right, where price is drawn to. So you just got to understand that, you know, I got to engage within the blue zones, right, within the highest probability ranges within the market maker model. All right. So, you know, like I said before, trading within those other zones and within the, like really the extremes after a market maker model is completed, that is gambling, because you don't have a narrative of where price is likely to go, right? That's not what we want to do. Okay. And by positioning yourself at the chart only when these specific times, by using alerts, right? You can see, the triggers that come as a result of not having a narrative and trading out of boredom, right? Those things won't arise when you're trading within these right zones. Okay. So this is going to help a lot, right? Definitely soak this in as much as you can, and look to implement it within your trading. So Braveheart actually mentioned this in his price action signatures video. This is actually a great tip that will help with your mental framework, within a market maker model, right? I realized this within my trading, that if I just waited for every time price formed a stop run to trade, I would have a very high win percentage, and I would, not be triggered by the things that usually happen. Why? Because, you got to understand that before, literally, like I said, before every significant price move that direction, there's going to be a stop run. Why? Because smart money, right, and the algorithm working together, they're going to hunt the liquidity that's in profit and get them out of profit, get them out of loss, right? Get them where they're not in the market, where retail's not in the market, and then they're going to run it in their intended direction, right? So you avoid unnecessary losses and exhaustion of mental capital by just waiting until a run on stops happens. So, taking a loss, and this is something that used to happen with me, right? Taking losses could potentially be a trigger to put someone on tilt, right? So you can avoid tilt. Like we said before, you want to avoid the environment altogether. You can avoid tilt altogether by just waiting for a stop run, then trading in line with the parent order flow. Another key gem, if you can't identify the liquidity, then you are the liquidity. All right. If you put your stop loss at a random place, it's most likely going to get taken because you are the liquidity. So putting it at key lows right after a stop run happens, that is safe. All right. Because they should not come back to your stop loss if they've already taken out liquidity. So then after the stop loss happens, we can, trade in line with the parent order flow. All right. So, what you can do is actually set alerts at key liquidity pools. So, just trading these levels within a market maker is going to help a lot, right? Just setting those alerts within the market maker model, like previous daily highs, previous day lows, like session highs, session lows, setting your alerts there. And when price hits that, okay, now wait for like a structured shift for value up entry and then trade in line. That's the easiest trading, highest probability trading that you want to do. And that helps your mental, right? Helps you stay in the flow because you're trading right after a stop loss happens, after a stop run happens, right? So this is going to help you, with consistency and growing your trading capital and also preserving your mental capital, because that's really what's important.